Hey everyone, this video is going to be a little bit different. Usually I talk about specific stocks and how they're doing based on their revenue, their cash flow, and their valuation and determine if they're buys, holds, or sells. This video, I'm going to look at the macroeconomy, the Federal Reserve, Chairman Jerome Powell, decisions that they make and how that impacts the economy at large, and then drill down to specific companies like Tesla, Nvidia, and Palantir, and how those policy decisions impact those three companies in particular. So let's jump right into it. Let's take a look at these details and let's understand and let's make that connection between macroeconomic policy by the central bank and how that impacts specific companies. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. All right, so today, Federal Reserve Chair Jerome Powell said that it will take longer than expected to achieve the confidence needed to get inflation down to the central bank's 2% target, signaling that it will also likely take longer to cut interest rates. Given the strength of the labor market and progress on inflation so far, it's appropriate to allow restrictive policy further time to work and let the data and the evolving outlook guide us, Powell said at an event in Washington on the Canadian economy. So let me zoom out and back up and try to put this all into greater context to start. The Federal Reserve, including Jerome Powell, their mandate, their job, their sole reason for existence, or I shouldn't say their sole reason, but their primary reason for existence is their dual mandate, a two-sided mandate. Number one is to keep inflation under control. And generally, that means keeping inflation around 2%. And number two, it means keeping unemployment at its natural rate. Now, there's always going to be unemployment in the economy. You're never going to have unemployment of 0%. You're always going to have some unemployment, and that's the natural rate, right? So if the unemployment is above the natural rate, now you've got some factors working in the economy that's increasing the unemployment rate, and it's the Federal Reserve's job to try and help bring unemployment back down to its natural rate. So given that greater context of their dual mandate, keeping inflation under control and keeping unemployment low, the tool that they use to achieve those goals are interest rate policy. So they increase or decrease interest rates to try and achieve those goals of low inflation and low unemployment. And the way it works is if you increase interest rates, if the Federal Reserve increases interest rates, it impacts directly the lending rates that people get when they go to purchase a car or when they go to purchase a home. So if your borrowing rate is higher, your monthly payment to buy a car, to buy a house increases, and so you're less willing to purchase those items, and so that decreases economic activity, which then brings down inflation. Okay? And the opposite is also true. If the Federal Reserve decreases interest rates, then that makes it more enticing to buy a car and to buy a house, which makes you more willing to buy those things. And if you buy a house, you're going to need to hire movers. The real estate agents are going to make money. The brokers, the lenders are going to make money. You might buy new furniture. You might buy curtains for your house. You might hire some people to come and update, or you might upgrade the bathrooms, the kitchen, and on, right? So it increases economic activity. That's the Federal Reserve's target when they try and increase and decrease. So what the Federal Reserve Chairman is saying here is that right now they have restrictive policy. So right now, their interest rates at above 5% are restrictive. They're trying to bring down economic activity because their main concern right now is inflation. Unemployment is doing just fine, right? I have here a chart of the unemployment rate going back all the way to 1950 here in the United States. Most recently, the unemployment rate was 3.8% in March as of March 2024. That's around the lowest it's been going back 60, 70 years, right? It's all the way down here. So unemployment is extremely low. The labor market is strong. I have here average hourly earnings going back all the way to 2014. And you could see over the last few years, ever since the economic reopening, the gains in average hourly earnings year over year have averaged over 4%, close to 5.5%, 6% at moments. Whereas before the economic reopening, before the pandemic, wage gains were comfortably below 3% between 2014 and 2018. So you've had a jump in average hourly earnings increase. So with average hourly earnings increasing, that's putting upward pressure on inflation. Restaurants, theme parks, hotel operators, airlines, car companies, they've all had to pay higher wages. And if they have to pay higher wages, then they're going to increase prices on the items that they're selling, which brings up inflation, and it feeds into a vicious cycle if the Federal Reserve doesn't get it under control. Because you have to pay higher wages, so you raise your prices on the items that you're selling. Then people see that they're having to pay higher prices for the things that they're buying. Then they go back to their employers and ask for higher wages. The employers have to pay higher wages because all people all at once are starting to ask and pressure for higher wages, and they can no longer keep wages down. And then if they have to increase wages, they have to raise prices again, and on. That vicious cycle gets inflation out of control and ballooning if the Federal Reserve and the central bank doesn't keep a lid on it, doesn't bring it down through higher interest rates. And it doesn't always work. But for most developed economies, the central banks have been able to keep a lid on inflation. Still, there is a risk that it goes out of control. So they've got to raise interest rates to keep that under control. But what the chairman is saying is that they need to keep interest rates higher for longer instead of cutting interest rates. Remember, coming into the year, most economists were predicting that the central bank was going to cut interest rates between 3 and 6 times. I myself was predicting that the Federal Reserve would cut interest rates 3 times this year. To start the year, that was my prediction. Now, I have since lowered that estimate down to 2 times this year. And in fact, in this video, I'm actually lowering that prediction again, going from 2 rate cuts, interest rate cuts I was predicting, now down to just 1 interest rate cut for 2024. I started the year at 3, I lowered it to 2, now I'm lowering it to 1 because the economy has came in hotter than expected. Unemployment still at record lows of last reached, in 75 years. Average hourly earnings way above expectations, way above the natural rate, way above the level that keeps inflation at 2%. And then if I look at more figures, the year-over-year consumer price index, you could see inflation peaked out at around 10%. And then as the Federal Reserve started increasing interest rates, the inflation rate came down, but it reached a limit of how far down it went, and it didn't approach that 2% target that the central bank has. It's hovered around this level, and in fact, it's rising recently, 3.48% in the most recent update. So given this push on inflation that's hotter than expected, at this interest rate, it doesn't look like it's restricting the economy enough to bring down inflation. And so the Federal Reserve needs to keep interest rates higher and talk about actually keeping interest rates higher for longer. Because even just the Federal Reserve making that statement, Jerome Powell just making that statement, is going to have an impact on financial conditions. Before they ever even increase the interest rates, their language, their forecast, their discussion impacts financial markets immediately. Because before they actually cut interest rates 3 times in 2024, they predicted, the central bank, their participants predicted, they were estimating they were going to cut interest rates 3 times this year. That's what I based my estimate for interest rate cuts on, is what the central bank was predicting. And their prediction, their public prediction of cutting interest rate 3 times, moved the market expectations already. That's partly why you've seen this rally in the stock market in 2024, because market participants were expecting the Federal Reserve to cut interest rates. And when the Federal Reserve cuts interest rates, it tends to have a positive impact on asset valuation. In fact, that's one of the primary learning objectives I have in my several of my classes at university. If anything, I make it sure that my students understand the relationship between interest rates and asset valuations are inverse. When interest rates go down, asset valuations go up. When interest rates go up, asset valuations go down. And that's because people have a choice now. If interest rates are higher, you can put your money in super safe government bonds that will now pay you 5.2% for 13 weeks. And so if you're thinking about investing in anything else, you're thinking you've got to get at least that 5.2% because you're taking on more risk. And if you're taking on more risk, you want more returns. And for that reason, companies like Tesla, Palantir, and Nvidia are now experiencing that downward pressure on their asset valuations because of higher interest rates. Now you might say, wait a minute, Tesla might be facing that. Tesla stock price is down in 2024, but Palantir and Nvidia are performing excellently in 2024. And you would be right. Those stocks, those two are performing really, really well. But they're performing really well despite the higher interest rates, not because of it. They're performing really well because artificial intelligence is the hottest investing trend that's happening right now. And these are the two of the hottest companies in AI today. So that's why their stock prices have increased despite higher interest rates, because that force has been stronger than the force of interest rates. Whereas for Tesla, the force of higher interest rates has not been offset by anything else. And to make matters worse, most of Tesla's customers, they finance their purchases. And so higher interest rates have made it less enticing for people to buy vehicles. And Tesla's been facing that double whammy of both higher interest rates making its stock less attractive, and then higher interest rates making its vehicles less attractive because of financing. So there's what is going on with the macroeconomy and how it's impacting stock prices. Now, the Federal Reserve Chairman making that statement, interest rates are going to remain higher for longer. He just made those statements today. I wouldn't be surprised if over the next few days, the market recalibrates its interest rate expectations, and those recalibrations start to have a negative impact on stock prices over the next couple of days. That's going to be offset by the fact that the economy is performing so well. Unemployment is lower than expected. Consumer spending is better than expected. Personal savings are better than expected. All of these macroeconomic factors based on the strength of the economy are better than expected. So those forces will offset each other. But it seems like interest rates remain higher for longer, and I'm revising my interest rate forecast, no longer expecting 2 rate cuts, now only expecting 1 rate cut for 2024. Before I let you go, let me tell you about the greatest deal on YouTube. With just a click of a button, you can get free financial analysis from a professor with decades of investing experience. So what are you waiting for? Hit that subscribe button, and I'll see you again soon.